Hello everyone, this is Jordan. This video is being recorded on the morning of June 8th, 2024. Thank you so much for joining me. In this video, going to talk about how gold's relative strength, specifically against commodities, is starting to perk up. Now, I know we're coming off an ugly Friday in the market, but this is something, it's something to always keep an eye on, but especially, I think, over the coming months. And again, specifically looking at how gold is going to perform against the other asset classes, because when gold strengthens in relative terms, that typically precedes the next, in nominal terms, it precedes those next big legs up. And so if gold is to correct here, even for a few more months, we want to keep an eye on the relative strength. Because, again, more strength there is going to precede more strength in nominal terms. So, anyway, enough babbling for me. Let's get into the charts. So, only two charts in this video, or two images, I should say. I've crammed lots of charts here in these two images. So, we're looking at gold against commodities in this image. Gold against commodities at the top, gold against oil, and then gold against copper. And so, this is the main thing that I'm talking about. Here we can see that in recent days, gold divided by oil has broken to, that's a 3.5-year high. So this is broken out to a 3.5-year high. And this is gold against an equal weighted basket of commodities, because the CRB is not that much different from oil. I've harped on this in other videos. I mean, I hate these goofy commodity indexes that they don't really indicate where commodity prices are. I saw someone on Twitter mentioning, well, you know, there's so many commodities in the last few years are at all-time highs. Why is this index near like a 15-year low? So that's a topic for a whole nother video. But my point is that I prefer gold against an equal-weighted basket of commodities. That's GCC. That's an equal-weighted commodity ETF. And so this has not yet quite broken out, but it's very close. Assuming it does very soon, that would be very close to, again, a 3.5-year high. It's already there against oil. And so the reason these ratios are important, as I already said, there's two reasons. But number one, gold typically strengthens in real terms before it does in nominal terms. So in other words, these charts strengthen before the gold price in US dollars does. And the same goes for gold and foreign currencies, and also gold against the stock market. The other reason is that I've talked about gold, the inflation-adjusted gold price, and how that's an indicator for gold stocks. It's an indicator of mining margins for gold companies. And again, that's gold. That's what gold companies follow. They follow that much more closely than the gold price. And so these are, I mean, you could say even at a lower level, these are indicators of mining margins or the profitability of gold companies. Look at the huge bad bear market. The gold price didn't go down all that much, but this is gold in real terms. This is gold against oil. So we know about the cost inflation. And so for the gold companies, this is what we want to see. We want to see gold strengthening against oil, which is for open pit mines, that's a huge cost input, and gold strengthening against commodities as well. Gold against copper, I mean, it's a different kind of indicator. You know, we had the big copper move. I think that's over for the time being. So I think this can rebound and strengthen and eventually break above this resistance. But even though it had a big decline here, this is still an uptrend here. So gold against commodities, it's looking good in real terms. It's a good sign for gold, also a good sign for the companies. And in this image, I'm looking at gold against the stock market. Here's the obvious one, gold against the S&P. This is gold against the equal weighted S&P, so all the 500 stocks weighted equally. And this is gold against the world, but it excludes the U.S., so it's basically gold against the rest of the world. And look, if you've been following me, you know I've been harping on gold against the stock market. I've probably done 20 videos on this in the last 5 years, maybe 30 videos in the last 10 years. I've written so many different articles. I've come up with numerous different titles to talk about the same thing. Look, when this chart finally moves like that and we get a big breakout, that's when you're going to see gold really explode. This is what's holding gold back from a real bull market where it's going to go crazy and double over the next few years. And obviously, I remember thinking a year ago or so, it looked like we were really close. Like, look how bullish this is. And then we had the sell-off. And so gold is still, relative to the stock market or the S&P 500, this has a lot of work to do to go like that. But the S&P 500, Mark Faber mentioned this in my interview with him, and you don't need to hear it from him or hear it from me. This is 7 stocks pulling up the market, basically. All this money is going into those stocks, and that's pushing the market higher. And that's why, look, if you look at the equal weight, it's weighting everything equally. This looks like a bullish chart, gold against an equal weighted stock market. This is a bullish consolidation that at some point is going to go like that. This is gold against the rest of the world. And it's even stronger than this one. I mean, yeah, you can call it a false breakout, but we can see, look at the moving averages, slowly grinding higher. Slowly grinding higher here. So I guess what this and this, well, more so this, what it's indicating is eventually when we see it move like that, that's going to pull this higher. And again, that is the real missing link for the gold market now. Gold has done really well without a weak stock market. We know that, but we want to see this move like that. Because I'm skeptical that gold can, maybe it can move up to 2,700. I'm skeptical gold can reach 3,000 with the stock market at new all-time highs. But I was wrong about gold breaking out. But we'll see. But I really doubt that unless we get a big move like that, I think gold will remain below 3,000. But it still could move up a little bit more before this happens. So that's basically, or not basically, that is the video talking about gold in real terms. And by the way, last thing, I didn't chart gold against bonds. I should have, because we know gold against bonds has gone, that's gone like parabolic. That's been on fire in recent years. So that has helped gold a lot, but gold needs to outperform here. Not outperform, it needs to make a big move. It needs to break out. I mean, I've already said it too many times. But enough babbling from me. You get the point. Gold against the stock market. If and when we see the stock market run into problems, the economy goes into a recession in the coming months or the next year, that to me is what is going to take gold to 3,000, 4,000, and 5,000 over the next few years. Let me know what you think. Leave a comment. Thank you so much for tuning in. Hope you had a great weekend, and I'll talk to you guys again in the next video.